Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. This is our first one of the year for this year, and it's been kind of a crazy start to the beginning of the year. We've actually been pretty busy, and I wanted to go ahead and kind of let you know what's going on because there's a lot of usual clickbait, crazy talk out there about. I saw one that recently was, again, the housing market's going to crash and this and that, even in our area. And it's just not the case, guys. It's not what we're seeing in the supply. It's not what we're seeing in the demand. And with the way interest rates are trending and what's about to happen in the next couple of months, it just doesn't make any sense. It's just a way for people to basically get their clickbait to stay relevant, to make some money. Okay. So guys, let's take a look at this in detail. And I'm going to go ahead and share the screen here. And let's take a look at some of this from the standpoint of what we're talking about. So here's just some recent articles just to kind of drive some of these points home and kind of put things in perspective. Wholesale prices fell 0.5% in December, much more than expected. Retail sales fall. Now, that sounds horrible, and it is for, the businesses that are taking a hit there. But for the inflation rate, it's actually something that we see, with wholesale prices falling. That's a good thing for the consumer, right? So we see in this that we've got producer price index declined 0.5% for the month compared to the Dow Jones estimated for 0.1% decrease. So again, to the good. A sharp drop in energy prices helped bring the headline inflation reading down for the month, even though it may not feel like it at the pump and at the heating bill, because, those things are still high, obviously. The PPI's final demand energy index plunged 7.9%. All right. So we're seeing, energy prices coming down a little bit. So that's good, especially with these crazy energy policies that we're seeing right now. And that is part of what's driving this inflation, because obviously if it costs more to, move goods and services around and that sort of thing, and we're having supply chain issues or just not releasing enough leases for more energy, then this obviously, puts you in and gives you higher prices. So we're seeing some of that loosen up a little bit. Retail sales fell 1.1% in December, slightly more than the 1% forecast. So all good stuff there. And then if we look at, down here further, prices for wholesale goods and services fell sharply in December, providing another sign that inflation, while still high, is beginning to ease. As we talked about, we said by January, at the very latest, we would see, and this was coming from Barry Habib again. He's going to be right every time, except for the things that come out of left field that aren't likely. But the things for are likely, as we always say in this podcast, it's a way to kind of gauge what to expect unless something comes out of left field. Now, one of the things that came out of left field, though, was obviously when we print more money and print excessively more money, which we've basically printed more money in the last couple of years than all of human history. And that creates more inflation. Okay. And the omnibus bill basically was another thing that came out of left field with the amount that was spent with $1.7 trillion there. So again, looking at what comes out of left field, what shouldn't be going on in government, what shouldn't be going on in printing money and those sorts of things, and all the money that we're kind of bleeding right now. And there's, worries about, bankruptcy, currency crashes and things like that. We've got to kind of get this monetary theory under control. There's no doubt about that. Unless we just like paying higher prices for everything and want to end up crashing like Venezuela. So these are the things that we've got to keep in mind. But we saw that these things are trending in a good way, and we should see according to what we're seeing in the new Congress, some more controls over the spending. So let's hope that continues. Now, here's another one. And of course, when we talk about the feds, I'm not a big fan of the Fed, and they certainly are always behind the eight ball. But Fed set course for milder interest rate rise in February. So basically, what this article gets into is the idea that we're going to see, instead of the 75 basis points or the 50 basis points that we've been seeing in the past several months, once they kind of made the decision to actually fight inflation, which they were late to the party on, which has caused kind of this stagflation in the market and in the housing market a little bit, because as it costs more to borrow money, we see the inflation drives the interest rates up. We've been having this issue, but now since they're getting it tamed, even though we can make the case right now that they've gone far enough, maybe going too far now, but they are going to only be raising the rates about 25 basis points over the next couple of months for each month as we go along. So that's basically what this article is talking about. Now, in a recession, we are typically going to see, where people are maybe getting laid off from their jobs and things like that. As a bad thing, obviously. A lot of these tech jobs that we're seeing these layoffs on, and a lot of these jobs that we're seeing, not all of them, but a lot of them are, companies that overhired during the pandemic because of some of the things that were going on virtually or with deliveries and things like that were at a higher rate during that time period. Some of them did overhire. Okay. And although the jobs market showed an increase in jobs, and first of all, the forecast wasn't really that, hard to beat, but it came in a little over. I know they were hoping for about 200,000 jobs. It came in at 225 or whatever, using the round numbers. But all that, all of that wasn't like, big time paying jobs, with those numbers that just came out in the last couple of weeks. It's, about half of those jobs are second jobs, or, people maybe taking on another job because they're not getting as many hours as they were before. So we are seeing this, that we probably are, most likely in a recession now, even though they haven't announced it yet. They're always announce it 2 to 6 months on average, as I've talked about in the past, behind when it's actually happening. But whenever we go into a recession, yes, people are going to get laid off. If we have a 1% tick up in the unemployment rate, we may see, something like, 1 million people out of work, which is absolutely horrible for the people that are out of work. However, for mortgage rates, when you're looking at, a home purchase, which right now would be a good idea because prices are down, and we want to get ahead of the curve. When prices are down, it's a good time to buy. And especially right now, rates are up a little bit. They were up over 7. Now the average rates, are going to be, and we'll get into this article here, but the average rates right now are in the low to mid 6s, depending on a day in the week. But mortgage demand has jumped because rates have come down. Rates were over 7 on average. Whenever we throw these numbers out too, like here it says average 30-year fixed decreased last week from 6 to 6.23 from 6.42. Those are just average numbers. Obviously, if you were to, work with a broker or one of our preferred lenders, so to speak, you get better rates than that. These are just averages that you're seeing. And again, they do change by the hour, the day, the week, and all that. But right now, again, we're still trending down. Remember, we were over 7 on these averages that we look at. And we see that the demand is up. The obvious reason, prices have, stagnated because of the interest rates. Okay. So people are lowering some of their prices, even though they still have tons of equity in most cases. People have lowered their prices in order to combat that if they need to sell immediately or right away, or to keep up with this inflation and interest rates that we've seen in the past. But now we're seeing this trending down in inflation. So we're seeing a trending down in rates. And that obviously brings our demand back. Now, not all the way back to where we were, but certainly an increase here in 28% demand. Okay. The one good thing that kind of counterbalances this that I'll talk more about in a minute is that our supply is low. Our supply of homes is low. So, that obviously has helped to keep all this in check. So, really good time to buy now, because if rates are trending down, you can always refinance later. Also, I did a separate video on this with one of our preferred lenders, Andrew Fisher. And, there's this thing called a 3-2-1 or 2-1 buy down. And basically right now, again, in the video, we kind of go through this a little bit more in detail. And in that example on that home, with decent credit, not the best credit in the world, but decent credit, you could be looking at rates around 2% your first year. Now, if rates are going to trend down, you can always refinance out to a fixed rate later. But it's important to know what your options are, because a lot of people don't know these things even exist, or they don't have access to them. So we see that this article here was talking about, this was on January 18th, that jumped nearly 28%. This more recent article on January 25th, weekly mortgage demand jumps another 7% as interest rates drop to the lowest level since September. Remember, we did have rates back in August, September that had dropped right around to almost around 5, depending on your credit and who you're getting your loan through. So this is a great news for anybody who's thinking about purchasing a home at this time, obviously. So one of the other components to this, and I'm gonna get into more detail here, but I want to get into our more hyper local market, and then I'll kind of wrap that up with what in more detail is happening overall in the housing market locally and nationally. So what we usually talk about here is what's called the Cromford Market Index. And that Cromford Market Index, or CMI, from the Cromford Report, people who tied right into all of our data from our multiple listing service, and they track everything that's been going on for decades now in the housing market. And right now we are technically in a seller's market in the greater Phoenix area, believe it or not. And again, this is just a recent shift again in the last couple of weeks that's happened, but we are at on the market index between 90 and 110 is kind of what is our gauge. So anything below 90 is a buyer's market on the index, and anything over 110 is a seller's market. So below 90 buyer, above 110 is a seller's market. And so that mid-range that we're looking for in a balanced market would be 100 on the index. So right now we're sitting at 111, okay? And that puts us technically into a seller's market. We are also seeing that our demand has ticked up at 74.7. It has ticked up. And our supply, okay, is actually at 67.2 on our supply. So we see that our supply is still very low, which has been counterbalancing all this. And we see that those numbers, the demand and the supply, are getting further apart, which, when they're together, that when they have the same number or close to the same number, that puts us more into what would be considered a balanced market. But what we're seeing is this trend towards a seller's market. And when we look at every city individually, we see on the index, we see that all of the arrows are in the green or pointing up. So what that means is for every individual city, we're trending towards or already in a seller's market. So for instance, Paradise Valley comes in number one at 167. Then under that, we've got Fountain Hills, Chandler, Cave Creek, Scottsdale, Phoenix, Glendale, Avondale, Mesa. Those are all the top 9 in a seller's market right now. So what that puts the rest of them at is we have then Tempe coming in 10th at 109, okay, which technically puts that into that more balanced trending towards that balance rate. But these are all going up. We see the Gilbert at 102. Okay. Peoria at 92, Surprise at 91, Goodyear at 72. We see Queen Creek at 61, Maricopa City at 55, and Buckeye at 54. But these are all up. The lowest percentage that has ticked up would be Maricopa City at 7%. And the highest percentage increase overall is Chandler in the last month and week. And we see, this increase of 22% over the last week, and the previous week, another 22%. And before that, it was about 19%. So we're seeing this trend up overall in these cities individually and overall in the index towards a seller's market. Okay. Now, some of that makes sense for 2 reasons. Obviously, we have the seasonal, right? Every year, whatever's going on in the market, pretty much doesn't matter. But every single year, after we get out of the holidays, things start to heat up. Okay. So they warm, then heat, then it gets hot, So why is that? Well, most people, not everybody, but most people are going to buy when school lets out, because they don't want to move until school lets out, or right around that time period anyway, right? So our school lets out, in May, towards the end of May, mid-May, and everybody wants to move right before that, right during that, or right after that, right? So they can be done and moved and unpacked and everything before the new school year and activity year starts in the fall or late summer for us. So again, you'll see that, we've shown that chart before. It goes up and down seasonally, late fall, and winter holidays, usually slower time, makes sense, right? Unless maybe you're talking about some of the winter visitors that we have, or, investors, second home type people that are looking at properties in the, adult type communities. So it's important to kind of keep that in perspective on what's really going on in the reality of things. But we've also seen this trending down in the interest rates. So the accepted contracts is something that's really big, because we see that we've got the highest number of accepted contracts taking place in January right now than we've had since August, which again was the time period where we saw interest rates drop to around 5%. So that made sense then. And now it makes sense because we're going into the new, hot time of the year, where the market heats up for us, and we're seeing interest rates trend down, right? So that all makes sense. Okay. Supply, demand, cost of everything, time of year, seasonality, all that falls right into place. So we're not seeing any crashes. We're not seeing any crazy stuff. We're seeing more showings in our Showtime system in the multiple listing service. We're seeing an increase there. We're seeing more properties going under contract. We're on our own listings. Anecdotally, we're seeing more foot traffic, okay, through open houses, through those people who have realtors that are setting up showing appointments. And we see that this trend is only picking up. So listings under contract, we saw that on the listings under contract, specifically in the last couple of weeks, we've seen the highest percentage on record in the, from the Cromford report in our MLS in the last couple of weeks. So it's gone up the fastest, not where it's been the most because we've got less than last year, but where it's gone up the quickest for properties under contract in the last couple of weeks in January. So that's also very encouraging and record setting. So we've got, right now, 6,000, a little over 6,729 homes under contract. So, the overall numbers, just to kind of, throw these out there, 77 days closed down market. We've got a 2.9 month supply of homes. Absorption rate is up at 33%. Our average list price is 718,000, and our average sales price is 515,000 and some change. The list to sales price ratio is at 96.67. Usually we like to see that more around 98%. Okay, but that's definitely trending up a little bit. And then we've got, as far as the price ranges, properties that are listed below 500,000 make up 57.37% of our entire inventory. Homes from 500,000 to $1 million are at 31%, and homes over 1 million are 11.6%. Okay, so again, the majority are still under that 500,000 mark, but we're seeing that mid-range is starting to tick up there in the over 500,000 range. So again, more demand, not a lot of inventory, and rates go down. Naturally, what happens is we see these numbers that we're talking about increase. Okay, and our supply, that's a good supply. Like we usually like to see around 2-3 months supply. That's a good brisk market. Okay, so all things being considered, very very, very healthy market from that standpoint. Now, I am going to share my screen one more time with you, and I am going to go over why you may have heard a lot of people are talking about May 10th being when we're really going to see a big shift, okay, in interest rates, and why. Okay, so I'm going to share my screen, and I'll take you through this. And let's see here. Let me get this up. Okay. Hopefully you can all see that. So when will inflation peak? Well, we're already seeing it. Inflation peaked, which we talked about. Okay. And I've explained this in the past of where we can expect this to happen. We said January right there. We're going to see, the next report come out on February 14th for the January numbers. Then we're going to see March 14th down at the bottom here on the chart. You can see these dates. March 14th, it'll be the next one, and then April 12th, and then May 10th. Okay. So reason why we're honing in on that May 10th date is because we, and when we look at these numbers, okay, CPI year over year, these numbers, were what we were looking at last year, right? All through the whole year of 2022. All right. So see this range right in here in the middle where we've got, March. Well, let's start with here. We've got January, February, March, April, May, June. Okay. See that right there? So part of this CPI, the core consumer price index, is also made up of shelter cost. Okay, 39% of it, okay, is core CPI. So what the shelter costs actually look like are this kind of, this big up and down over here on the right, year over year. That's what we're looking at, and right into January, okay, we see that they're coming down, right? And we see that they've been coming down since around July, okay, or June, July, right in that range. They've been coming down, okay. But what the Fed sees, because they always have to, like, everything's lagging with the Federal Reserve, okay. Now they don't set the interest rates, but they do, they can tame inflation, right? With these increases in the Fed's fund rate. Okay. So it has an indirect effect on it anyway. All right. So what they're trying to do is they've been trying to tame inflation by raising the cost of what it costs to borrow money for anything. Okay. So that it can stop inflation. It can destroy the demand on things. Okay. In other words, you're not going to spend your money if it costs more to spend or borrow that money. Okay. Or borrow that money for that car or that home or whatever. So they're always in the lag. They're always looking, they got to wait for the data, then they kind of think about it and then they figure it out rather than looking ahead. It's like when you're driving your car, you're supposed to be looking ahead at what's coming up, and what's going on now and what's coming up, right? They're always looking in the rear view mirror or maybe now. So they're always going to be behind the eight ball, and they always have been. So so when we see these numbers here that we're looking at, we saw this number come up, and the real shelter costs are coming down. Okay. And they're coming down in a big way, especially once we get to May 10th. And when we put these shelter costs in line on the chart with the other chart we just showed you, you can see right here, as these numbers come down year over year, if they come down year over year, that's good. That means that inflation is coming down. Okay. And we know shelter costs are coming down, which is 39% of that. Okay. So in January, we have this little thing with insurance basically that goes out that kind of takes about a 1/10 of a percent increase in the overall CPI. So then we get into February. Okay. We see where these numbers, that 0.5%, we're already trending to be below that. Now March, so when they come out with their Fed announcement in March 14th, we're going to see that our numbers are most likely going to be, from what we see now, below this for January and February. Okay. So in other words, in 2023, those numbers are going to be lower. That's going to be good. Okay. The bond treasury market, they're all going to be happy about that. That means, rates continue to trend down. March, we're going to see that not much is going to happen in March because it was already low then. Okay. But when we hit this May 10th date and announcement, we're going to see for April, for their report for April, we're going to see May 10th that report come out for April. And because these numbers, were 0.6 in April, and then May 0.6, and then June of last year, these numbers were high on inflation. Okay. And increasing, we're going to see where this year those numbers will have decreased because of the demand destruction that the Fed finally caught up with and did. Okay. And like I said, they're still doing those increases in the Fed's fund rate, but they're decreasing it to about 25 basis points instead of the 75 or 50 basis points that they were doing in the last several months. So that's why we're going to see this shift by May 10th, where we're going to see a big acceleration, okay, in these interest rates by then. Okay. So, guys, that's all I have for you today. If I were you and I'm a buyer or seller, if I'm a seller, I'd be thinking, okay, if I need to sell now, great. If I don't, maybe I might want to wait, till around that March or April date, and then start, listing my home around then. And it's a busier season anyway. But if you need to sell, things are, again, low supply anyway, and demand is creeping up anyway. And for, again, January, February, we're going to see where, inflation is going to be lower than it was last year. Rates are going to continue to trend down. March, they're going to kind of just stagnate there. And then when we get to the April, especially that May 10th reporting on April, we're going to see a huge development there. If you're buying, number one, if you can find what you're looking for and you can afford to buy now, it's a great time because the cost is lower. As demand goes up and if supply stays low and rates drop, people are going to be out there buying. Now, you want to be ahead of that. You don't want to wait for that. A lot of times people think, I'm going to wait till we get to that. No, don't wait till you get to that, because now you can get the lower purchase price. You're not going to have a payment for about 2 months. So you'd be going right into that. And as demand increases and supply still is pretty low, and nationally we're low too. We're still low nationally, which I've talked about in the past too. These prices right now are great on new home, resale homes. Okay. A lot of builders right now are offering huge incentives. You can do the 3-2-1 buy downs, the 2-1 buy downs, which I mentioned before, and then refinance out of that in a few months when the rates drop. So guys, get the low price now, go a couple months without a payment. You're right into this kind of realm of what we're talking about. It's going to happen. And then from there, you'll be sitting pretty, because now you've increased your equity with the higher demand that's happening and the lower interest rates and this frenzy that's going to take place when everybody's trying to catch up with what's going on. You've already been in the game. You've already been in this game. You've already increased your equity. Now you can refinance the lower rate. You've already got the lower rate with the 3-2-1 buy down or the 2-1 buy down that we got you for the negotiations from the seller to pay down your rate. You're not even having to pay that down. And you can even transfer that money that's sitting in that escrow account to your refinance. So guys, to get it in more detail, let's talk with you a little bit more. Reach out to us anytime. We'll put you in touch with one of our preferred lenders. You can always compare them with your lender, and then we'll go from there and see what works out best. I think you'll find that when you're working with one of our mortgage brokers, you're going to see lower interest rates. You're going to see lower fees. You're going to see much better service. You're going to close on time. And again, if you want to look at new homes, do that with a realtor also, because we're going to know a little bit more about each builder, what's the good to bad. We're going to know what they're offering on those incentives. And, one other thing, I'm going to do another video on this. One thing that's going on too, a lot of, and it has been for a while, but you get into one of these builders and it sounds like you're going to qualify for the house because the salesperson kind of runs through a proposal sheet, but that hasn't been run through with the loan officer yet. You haven't been pre-qualified with that in-house lender yet. You may not qualify for that much, especially when you want to get the upgrades you want, or even with the base price, or with that spec home that's a quick move in. It may sound like you're going to qualify when you just talk to that salesperson, just by them running numbers in thin air based off of what you're verbally saying. But once they get your pay stubs and your W-2s and they run your credit and it gets through pre-underwriting, you may find out after you've already put your earnest money down, oh, we don't actually qualify, which could be a problem. It could put your earnest money at jeopardy possibly. If you don't have someone there like us to kind of pre-vet all that. Also, not being able to compare that with an outside lender and what to look out for and the pitfalls in that. So guys, be careful, and always be represented by an experienced realtor that knows what they're doing, that can kind of go through all these details and explain these things to you. Super important not to just jump right into something willy-nilly that just sounds good, but even though it's on paper and it could just be a preliminary verbal in the thin air idea without actual documentation and credit reports and everything and pre-underwriting to back it all up. All right, guys, till next time. Check us out at MancolaHomes.com, MancolaGroup.com. You can always call or text us at 480-788-8569 or email us at home@MancolaGroup.com. Thanks a lot, guys. We'll talk to you next time.